Private equity, this mysterious term which basically means a leverage buyout. And what they do is they buy companies the same way that you or I might buy a house. However, there's a big difference. When we buy a house, we put perhaps 25, 30% down and borrow the rest. They do the same thing, yet the critical difference is the company being acquired borrows the 70%, not the buyer. And then the company itself is responsible for repayment. And that's where the problems start. For the company being acquired, now they have a ton of debt. A lot of the private equity game is juice earnings fast, take advantage of it, but it's going to hurt the business, and then that company often is going to collapse. But the guy making the most money, the private equity firm, the Colbert Kravis Roberts, the Blackstone, the Carlyle, they take zero risk. Private equity investor gets their money mostly from state pensions. They're really not using their money. They raise buyout funds and use that to put the 20 to 25 to 30% down in leverage buyouts. Then the banks, and the largest banks, JP Morgan, Goldman, Citi, are lending the money against the company, using the company as collateral essentially, to finance the deal. So private equity firms are taking very little risk. When John Q. Public, when you or I are buying a stock, sure, we're taking a risk. Stock goes down, we get hurt. Stock goes up, we do well. For a private equity firm, typically they make fees off of their investors. Plus, it's not their money. They can't lose because of the fees they collect. And they can do very well if they can buy and sell their companies for a profit because they get a free 20% commission. And when you're talking billion-dollar deals, $10 billion deals, $20 billion deals, that's a lot of money. If Clear Channel should go bankrupt, which is a distinct possibility, though probably in a few years, as we're talking, they've just refinanced their debt to a point that they kind of kick the can down the road. If and possibly when they go bankrupt, for the private equity owners, I'm not saying, they're certainly not hoping for it, but they will basically break even or make a little bit of money off of fees when you combine everything. However, for the investors, the state pensions like New York State and others, they will certainly lose out. It'll be a losing investment for them. For the banks who have made the loans, again, it's been syndicated out, but they're losers. I mean, they don't collect on their loans. So there will be a lot of losers, but not the guys doing the actual buying. The huge tax loophole that makes private equity possible and profitable, I should say really what makes it profitable, is that when a private equity firm buys a company, by having the company borrow most of the money to finance the deal, mostly they're doing it with other people's money, is that money that the company borrows, the interest they pay off their loans, they can deduct from taxes. So the companies private equity firms owe pay about half the tax rate as other companies, because most companies don't have that kind of debt. The most simple solution is ending interest tax deductibility on corporate takeovers. It's easy, it's one swift move to the tax code, it makes perfect sense, and it will make the most aggressive buyouts, like the one for Clear Channel, unprofitable, so they won't happen. That deductibility was never intended to finance LBOs. That interest tax deductibility is supposed to be so you grow a business, so you maybe start a new plant. It was never, maybe you invest in research and development, you borrow money for that. It was never intended so you could finance an LBO, but that's how it's used, and it's legal. So I would say close the interest tax deductibility just for corporate takeovers, so that way mortgage holders can still take an interest tax deductibility. Why should a company that's taking on debt be able to take the interest off that debt off of their taxes when the money was borrowed so a private equity firm could buy the business? It's not logical. It doesn't make sense that people should be able to borrow money to finance acquisitions and then take the debt off that money, declare a big tax loop and take advantage of a big tax loophole. I mean, the whole idea, I guess, to me, you know, when you hit most people with, okay, this is how a leverage buyout works. Private equity firm buys a company, has the company borrow the money to finance its own sale. I think there's a lot of, what? That can't be right. And I know that was my reaction when I first started covering the industry, and after a few months put it together. But it's legal, It's correct. It doesn't make sense. And then, okay, logically, company borrows that money. The private equity firm says, we're going to improve that company by putting it in deep debt, by anchoring it with loans. That doesn't make sense either. And you know what? You look at the evidence, it doesn't make sense. And then the company is going to be able to pay much less in taxes because we're encouraging it to borrow the money to finance its own sale and put itself in deep debt. That also makes no sense. The whole idea of leverage buyouts makes little sense once you really look behind it.